It's great to see that so many people have come along to hear about banking regulation. And it's no doubt because you all read The Australian, obviously, and you're a big fan of my very small government extreme column on Friday, which you should read. Just to explain why I'm interested in this topic, I was actually in the UK in 2008, and that's towards the end of the year. That was kind of the peak of the global financial crisis, I guess. It was very scary, and I just realised that there was something gravely wrong with the financial system. That it, I think, more than anything else, and the insidious nexus between banks and a government is, in my view at least, really what caused that crisis. And so ever since then, I've taken an interest in it, perhaps disproportionate to economics more generally, which is what I write about. So so that kind of explains my particular interest in this. Now, the title of this, more dangerous than standing armies. That's a quote from Thomas Jefferson from 1816, I think. So that's just to remind you that this has been, banks have been an issue for a very long time in public policy, even going back to, 200 years ago. I think we forgot how important banks are in the few decades leading up to the global financial crisis, and they got a bit carried away. They got a bit away from themselves, and I don't think, even though the economics profession knew that there were serious problems, policymakers, including central banks and prudential regulators, did not really want to acknowledge those problems because it was so convenient for them not to. So basically, this issue of too big to fail banks, this is a reason, in my view, why the financial crisis occurred. We had banks getting very, very large all around the world. Even in Australia, credit grew between 1990 and 2008 from something like 75% of national output to 150% of national output. And of course, that all feeds through to house prices and all sorts of things. So all this stuff goes through the roof. So the impact of the banking system, I'm trying to say, is extremely widespread and comprehensive. And economists knew about these problems for a long time, like I said earlier. Now, the cost of the GFC, we've been so insulated in Australia, we haven't really had to deal with it, but globally in Europe and also the United States, it's been immense. For instance, as I got there, the European Union spent something like 30% of their GDP, trying to save their banks, and indeed, 4 years later, they are still trying to save their banks. So the European Central Bank has now had to completely contradict its treaty of a few years ago and basically create unlimited amounts of money and effectively give it to these institutions, so so they don't fall over. And the morality of that is extremely questionable, but the ECB thinks that is the best thing to do given the circumstances. So basically, what is wrong with these too big to fail banks? Well, firstly, there's a reduction in competition because you end up with a set of very, very large banks, just like we have in Australia, where there are only 4. And these banks are willing to take on more and more risk because the government basically will, regardless of what the government says, and this is a crucial point actually. In the lead up to the GFC, governments often said in writing and in words that they would never bail out banks. They always said that it was very competitive. They wrote it down in law. They would never ever bail out banks. They said it over and over again. And of course, what happened? As soon as there was a crisis, they started bailing out banks. And in fact, not only banks, but in the United States, they also bailed out car makers and various other insurance companies as well. So the economists knew that this would probably happen. But like I say, the consequences of this knowledge was never built into public policy. So in Australia, we see the ramifications of this as well. And in a little bit, I'll try to explain the size of this implicit guarantee, and this is the factor, this is the phenomenon, if you like, the implicit guarantee that basically allows banks to grow so large. And I did a back-of-the-envelope calculation as to what that's worth to the Australian banks, and there's no official study looking at this anywhere. And I gave a talk on that subject about 6 months ago at the Reserve Bank, and it did not go over very well because they don't really want to know about this issue. It's part of the title I said was the insoluble dilemma. It really is a huge dilemma. There's really no easy answer, and so policymakers don't really want to deal with it. But it is very important. Too big to fail banks also have a huge incentive to get bigger. So we've seen in Australia, for instance, that the Commonwealth Bank gobbled up Bank West in 2008, and Westpac bought St George. So this obviously made the big 4 banks even bigger. I think they now control something like 90% of the housing market, up from about 70% or 75% before the crisis. So there's this huge incentive for these too big to fail banks to get larger and larger. And the bit about excessive risk, well, because the managers of the banks and the employees of the banks won't ultimately have to wear any of the losses of their own behaviour, they have a massive incentive to basically leverage up and trade and be extremely risky. Because, of course, I mean, let's just take the employees first before we move to the shareholders. If you take the employees, they have it best, because once they get paid their bonuses or their huge remuneration, they never have to give it back again. So even if they get sacked, which is the worst possible thing that can happen, it doesn't really matter because they are already very wealthy, and the banks can't claw back the money. And let's take the owners of the banks, the shareholders, who of course have actually extremely limited control over the things they own. The CEOs, who are ultimately employees, of course, they are not business people. CEOs are not business people. Don't let anyone tell you that. They are managers and they are employees of the company, just like the other directors. The shareholders, of course, have limited liability, which is this amazing creation from 1862. In fact, this is the 150th anniversary of the company, just by the way, I think, if my math is correct. And the company was this amazing creation, which was originally given to ventures that were very risky. And so therefore there was some public interest in granting limited liability, which of course is a artificial construction. It doesn't occur naturally in the world. It's a creation of the state. You know, you give these owners the right that they can only lose what they put in, right? That's quite a powerful thing. And originally it was never applied to banks. That's only a relatively recent phenomenon in the past 100 years or so. And in fact, if you had have said that concept should be applied to banks or indeed insurance companies in the 1800s, people would have thought that you were somewhat mad, because of course that would, you know, cause banks to grow very, very large and they wouldn't be very, very risky. So the subsidy in Australia to banks. So this is this issue of the implicit guarantee I was talking about, which policymakers don't really want to deal with. So in Australia, the way you work it out is, okay, so we have 4 large banks, and if we assume that there is some sort of implicit guarantee, then that means that they can borrow much more cheaply than a smaller bank can. Because the people who are lending to the bank, which is generally foreign institutions and so forth, and also big, say, domestic pension funds, superannuation funds, they know that they'll probably get their money back regardless of what the bank does. So straight away, people lending to the bank don't really care so much about what it's doing with its money, right? Because they know that they'll get their money back. And so in Australia, you can basically assume that this guarantee is over all of the bank's wholesale liabilities, and that comes to about $900 billion across the big 4, right? So the big 4 banks have borrowed at any one time about $900 billion. Of course, they have a lot of deposits as well. That's completely separate. I think deposits are about 1.3 trillion on top of that. So that's just one side of the bank's balance sheet. Now, Standard & Poor's made this analysis very easy last year when they explicitly said for the first time, and this was extremely helpful for my analysis, they said that the banks in Australia are rated AA-, which is their credit rating, basically, to give people that lend to them some indication of the likelihood of getting their money back. And AA- is extremely high rating. In fact, there are only about 14 banks in the world that are actually rated that by Standard & Poor's. And they said that the only reason they are AA- is because of the implicit support that the Australian government provides, right? So this is very embarrassing for the Australian government, if you like, because they would say in public that they're not guaranteed, right? Even though, of course, that's complete crap. They are. So they said a high likelihood of extraordinary government support in a crisis. So for that reason alone, the big 4 banks and the big 4 Australian banks alone are rated 2 notches higher. So then it's quite easy mathematics once you have that information about 2 ratings notches. Then you just go and see what companies who are rated A are paying on their borrowings and what the major 4 banks are paying on their borrowings. And you take that across $900 billion, right, which is a real lot of money. Anyway, I worked it out that it is somewhere between 45 and around 80 basis points every year. So less than 1 percentage point on all their borrowings, between about half and almost 1. And that works out to be somewhere between $2 billion and $7 billion every single year. So that's a massive, that's a quarter of their total profits or something, if you like. It's a very, very large benefit to the major Australian banks, right, this implicit guarantee. And so over time, of course, that subsidy helps them make very large profits, obviously, because they don't have to pay the higher rate. It means they can pay higher salaries, and it means they can purchase smaller banks, and basically all the things that we've seen occur. And of course, not just in Australia, the banks in Europe and the United States were also subject to this. And in fact, there were much more extreme and grave consequences occurred there because they grew even larger because they're much larger countries to begin with. We had something that helped us in Australia a little bit, and it's a really interesting aside. We have this thing you may have heard of called the 4 Pillars policy, where the government, it's not written down anywhere, but there's just this assumption that the government will not let any of the major banks buy each other. There's even a debate as to whether they'd let them buy AMP, which is really the only kind of remaining kind of large financial institution left. So now the stated aim of that is supposedly to improve competition, but actually what it did in practice, and this is one of the reasons why Australia survived the GFC, if you like, is that the banks, the major Australian banks, never had an incentive to leverage themselves up to basically not be bought. It's the last thing the managers of banks want, the CEOs and so forth, the people who are paying themselves enormous salaries with other people's money. The last thing they want is to lose those sinecures, right? And so they don't want to be bought, because that obviously means the boards kind of go and the senior management go, and it kind of consolidates and so forth. And so there was less of an incentive for banks to become artificially huge in Australia, right? Whereas in the US, where there was no such policy, and also in Europe, where there was no such policy, banks were very, very vulnerable to being bought out by one another. And that indeed occurred, and banks got bigger and bigger and bigger. There was a huge consolidation amongst the big French banks, the big British banks, also the big US banks. And so it's interesting that this policy we had, the 4 Pillars policy, which was meant to enhance competition, actually had a side effect of discouraging the Australian banks from getting into all the risky kind of asset classes that banks overseas indeed felt compelled to make themselves more and more profitable in the short term and larger, so they couldn't be bought out. So that's an interesting aside, and that's, I think, well, at least the former governor of the Reserve Bank, Ian Macfarlane, basically said that in quite a controversial speech, and that was like after he was governor. He certainly would never have said that when he was governor, but he gave that speech about 1 year after he left. And just basically explained that, in his view, it was that 4 Pillars policy which had this totally unintended consequence of basically meaning the Australian banks were a lot more secure. Now that said, the Australian banks, well, I'm going to put it to you, if your total assets fell by 6%, right, 6 or 7%, would you be insolvent? Most of you would not be insolvent, I gather. I mean, I know this is a student audience, but I still, even despite that, I don't think you'd be insolvent. But the major Australian banks, if their assets fell by just 6%, they'd all be insolvent, basically, right? They'd basically be bankrupt. So I'm just trying to indicate how leveraged these institutions are. So for their assets to fall below the value of their liabilities requires a fairly small decline in the total value of assets, right? Now they say they have capital ratios that are much higher, about I think 11 or 12% are the official capital ratios of the major banks in Australia. So that means, well, they basically have to keep aside 12 cents, if you like, for every dollar that they get in. So of course, when you give your money to the bank, they don't hold on to it, it goes out, right? They only keep a tiny amount aside. That's the problem with banking. If everyone goes to get their money back, it's a massive disaster because the money's not there. But the key thing to know about those ratios is that those ratios are based on risk weights which are like arbitrarily assigned to different classes of loans. So housing lending in Australia gets basically a 0 weight, so they don't really have to keep any money aside for a housing loan, unlike a business loan where they do. And so there's a huge incentive for the banks to basically get involved in housing lending and not business lending. And I guess you could say that's for somewhat arbitrary reasons, because these risk weights are set by regulators, and ultimately it comes from some sort of global accord that was set in 1988 and then it's been tweaked ever since. But they are kind of arbitrary ratios that say, well, if you have a housing loan, then you have to keep aside this amount of money. If you have a business loan, then this amount of money. If you've lent to a government, then you don't have to keep any money aside. Now, of course, in the European case, that's been an extreme fast. So you've got all these banks who've lent to governments, including Greece and Italy, and they've never had to keep any money aside for these loans. But anyway, just back to the Australian case. So there's been a huge surge in housing lending. Now, of course, if there was a change in the unemployment rate in Australia, if the resource boom suddenly ended, these mortgages that the banks have would not be worth very much, because there'd be a lot of people not paying them back, and house prices would obviously fall. So, you may say that the banks are undercapitalized, and certainly if you go back through history, banks today, all around the world, keep far, far less capital than they used to. So they're, at least in my view, and also the view of some very senior professors who are not in the bureaucracy, the banks are grossly undercapitalized. And of course politicians quite like this because they want them to lend, and it's all very short-term, lend money and, lend really cheaply, it's great for votes. But but when it comes to a crash, it's a real crisis. So some people say, well, the too big to fail banks, we need to, basically get rid of them. Indeed, it was Mervyn King, the governor of the Bank of England, said in 2009, very frankly actually, he said, well, if they're too big to fail, then they're too big. But of course, that somewhat dramatic statement has never been followed through. We still have the massive banks, so what regulators are trying to do around the world is to try to increase the capital ratios that banks have. But you see, they are hardly increasing them at all. In fact, the headline capital ratio of 8%, which has been the minimum since 1988 for all banks, is still going to stay. It's just that the types of capital that count are changing. So the actual ratio are staying the same. So what should we do about this in Australia and globally? Well, I think one solution, which I think is very sensible, is firstly the rates have to increase. The capital ratios have to increase a lot. And the banks don't like this because it's basically expensive. It basically reduces their profit. This is more expensive to hold on to equity, to shareholders' funds, than it is to have other liabilities. So there's a short-term hit to their profits if they're forced to hold more capital. And it also reduces the amount that they can lend out. So that also affects their capital. And of course, that's another reason why politicians don't like it, because there would be a short-term reduction in the amount of lending that goes on in the economy, which of course is, if you follow Australian politics, would be anathema. The banks are always being encouraged to lend more by politicians at both sides. So, then there's these things, these convertible liabilities, and these are really interesting. And in Switzerland, in fact, I can change the slide now because I've just got. So in Switzerland, they have two very large banks, UBS and Credit Suisse, and they're much larger than any of the Australian banks. Yep. And the Swiss government has basically forced them to have much higher capital charges, I think between 12 and 15%. And the British government is going to force its banks to have capital charges of up to 17%. And in both of these jurisdictions, the banks are going to be forced to have these liabilities that basically convert to shares in a crisis, which is really, really awesome, because it suddenly means that those liabilities, those people that have lent money to the bank, at some threshold point, they suddenly become owners, right, without having any choice. And so suddenly, if the value of a bank's assets are starting to fall, then there's some trigger point at which some of the borrowings of the bank will suddenly turn into shares. So if you force banks to hold enough of these, then really the government doesn't need to bail the banks out ever, because basically the lenders will become owners whether they like it or not. And of course that risk will be built into the price, the rates of the loans and so forth at first. But it is, I think, a very convenient way to instill some discipline on banks, because if you did that, they wouldn't be able to borrow so cheaply anymore, because the people who are lending would know that there's a big risk that they'll become shareholders at some point if the assets fall. So that's one good idea. And so I think this is my last slide, so I'll just be quick. So basically in Australia there's been, like I said before, very, very little push to change anything really. We're adopting this Basel III Accord, which is being rolled out around the world, which is extremely timid and weak response to the global financial crisis, which doesn't really change the status quo at all. It's still all the same fundamental rules. As I say, they've just tweaked the definition of some forms of capital and made it slightly harsher. So in Australia, we're just going to implement that, and that's all. There's this concept in Basel III Accord of domestically important financial institutions, these D-SIFI things. But the Australian regulators have basically decided to ignore them and not put any at least formally harsher restrictions on the major banks. And if you want to be really cynical, I think that's partly because they all want to go and work there at some point, because that's where the big salaries are there, and you don't want to, if you're at the RBA or APRA, and actually their salaries are very, very large now too, but they're not quite as big as in the private banks, and so you don't want to damage them too much, right? The coalition, the opposition leader is talking about, well, actually not the opposition leader, the Shadow Treasurer is talking about this new inquiry, called a Son of Wallace inquiry. There was an inquiry in Australia in 1998 which basically laid out the foundation of the current financial system in terms of regulation. Well, the opposition has said that they'll have another one if they win government, although I'm quite sceptical that there would actually be much change from that, given the reasons that I announced before. But I think that's it. Yep. So thank you. So please ask questions. I hope there are a few questions. So.